The markets are currently closed for the weekend, but the STRV 500 ETF, trading under the ticker symbol STRV, finished the last trading session at exactly $42.57 per share. In the final hours of Friday's trading, we saw the fund push slightly higher, registering a gain of 0.18% for the day, which tracks closely with the broader movement of the S&P 500 index it aims to replicate. While a fraction of a percentage point might seem negligible to the casual observer watching the ticker on their Robinhood app or Fidelity mobile app, this subtle movement caps off a week of intense volatility, where the fund tested lows near $42.11 before buyers stepped in to defend the support levels. If you are looking at the after-hours data on your Interactive Brokers trading platform, you might see flatlining liquidity, which is typical for ETFs of this size over the weekend. But the closing price of $42.57 is the hard figure you need to mark in your ledger. Most investors look at STRV and see a simple, passive index fund, a vanilla product designed to mirror the U.S. large-cap market. That is the expectation, a slightly more expensive version of the Fidelity or Vanguard S&P 500 funds, charging approximately 0.05% compared to the razor-thin fees of its gargantuan competitors. But here is the reality that most financial media glosses over. STRV is not just an investment vehicle. It is a political weapon and a corporate governance battering ram. While you might be holding Tesla stock or Apple stock through a generic fund, those funds are often voting your shares in ways that align with environmental, social, and governance mandates that you may not agree with. The reality of STRV is that it decouples your capital from the ESG voting bloc of the Big Three, BlackRock, State Street, and Vanguard, and reaggregates that voting power to enforce a mandate of excellence capitalism. You are not just buying the S&P 500, you are buying a proxy vote that screams profits over politics in the boardroom. This distinction is the critical value proposition that separates STRV from being just another line item in a Schwab Intelligent portfolio. Let us analyze the recent price action because the chart tells a story of resilience in the face of macroeconomic headwinds. Over the last month, STRV has seen a pullback of approximately 2%, mirroring the broader tech-heavy index contraction, yet it remains up over 11% on the year. This mirrors the performance of the underlying heavyweights it holds. When you look at the top holdings, you're seeing a massive allocation to Nvidia stock, Apple stock, and Microsoft. These three companies alone account for nearly 20% of the fund's weight. The recent intraday price action we saw on Friday was largely driven by a recovery in the semiconductor sector, where Nvidia stock bounced off a key technical level, dragging the entire index and consequently STRV higher into the close. Volume on Friday was roughly 44,000 shares, which is lighter than the average daily volume of 76,000. Suggesting that the move up was driven by a lack of selling pressure rather than a flood of new institutional capital. This creates a fascinating tension for next week. Low-volume rallies often get retested, so if you're managing your own individual brokerage account, watch the $42 level closely. If that breaks, we could see a flush down to the 50-day moving average. The broader context here involves the parent company's aggressive maneuvers in the capital markets. STRV Enterprises has been making headlines that ripple down to the brand perception of its ETFs. While STRV is the passive equity arm, the parent company has recently structured itself to hold Bitcoin on its balance sheet, raising capital to acquire digital assets in a move that mimics MicroStrategy. This is a radical shift for an asset manager. Usually firms like Fidelity Investments or SoFi Invest keep their corporate treasuries in boring short-term treasuries. STRV is signaling that they believe the US dollar is structurally flawed and they are betting the house on hard assets. While this doesn't directly change the holdings of the STRV ETF, which is strictly bound to the US large-cap index, it changes the ethos of the firm managing your money. It signals that the people voting your proxy shares at shareholder meetings are not risk-averse bureaucrats. They are aggressive, contrarian allocators who are willing to break the mold. This creates a halo effect around the ETF, attracting a specific type of investor who is tired of the traditional financial system's rigidity. When we strip away the narrative and look at the mechanics, STRV functions by physically replicating the index. This means when you buy a share on your SoFi trading platform or through interactive brokers, the fund manager takes that cash and buys the actual underlying shares of the 500 companies. They don't use derivatives or synthetic swaps to achieve this exposure, which reduces counterparty risk. This is crucial for those engaging in self-investing who worry about systemic stability. If the banking sector wobbles, you own the actual stocks. However, the differentiation comes in the stewardship. Most investors using investing sites like Robinhood or Fidelity do not realize that they effectively surrender their voting rights to the fund manager. In 2024 and 2025, we have seen STRV Asset Management vote against board members at major oil and gas companies who were planning to reduce production to meet a net zero target. STRV's argument was simple. An energy company's fiduciary duty is to produce energy and make money, not to self-immolate for a climate pledge. If you hold Fidelity ETFs or Fidelity mutual funds, your shares likely voted for those net zero targets. If you held STRV, your shares voted against them. That's the tangible difference your 0.05% expense ratio buys you. The sector allocation of STRV is heavily skewed towards information technology, which makes up nearly 36% of the portfolio. This is a double-edged sword. On one hand, it exposes you to the explosive growth of AI and cloud computing. On the other, it leaves the fund vulnerable to interest rate shocks that disproportionately hurt high-duration tech stocks. We are currently in an environment where the Federal Reserve is balancing sticky inflation with a cooling labor market. If rates stay higher for longer, the valuation multiples of Nvidia stock and Tesla stock come under pressure. Since STRV is market cap weighted, a 10% drop in the Magnificent 7 stocks drags the whole ETF down significantly, regardless of how well the other 593 companies are doing. This is why some investors engaging in online investing might pair STRV with an equal weight ETF or a value-focused fund to dampen that volatility. However, if you believe that we are entering a new productivity supercycle driven by AI, then the concentration in STRV is exactly what you want. You're essentially making a leveraged bet on American technological dominance without the risk of picking a single winner. Let's talk about the user experience of buying this asset because it varies wildly depending on your platform. If you're using Robinhood stock trading, the interface is gamified, encouraging you to trade in and out. But STRV is designed as a core holding, a set-it-and-forget-it asset for the long term. The Robinhood app makes it easy to see the price swings, but it often lacks the deep fundamental data you might need to understand the proxy voting record. Contrast this with interactive brokers, where the interactive brokers platform allows you to generate detailed reports on portfolio beta and covariance. For a sophisticated investor, interactive brokers is likely the superior venue for holding STRV, because you can utilize their yield enhancement programs to lend out your shares. Though you should check if this affects your voting rights, which is the whole point of holding STRV. On the other hand, SoFi Invest and the SoFi Robo-Advisor ecosystem are excellent for younger investors who want to automate their buying. You can set up a recurring buy of STRV every payday on SoFi, dollar-cost averaging into the position without trying to time the market. This creates a disciplined approach to building wealth that removes the emotional sting of red days. One of the most interesting aspects of the current market is the disconnect between the real economy and the stock market. Inflation has cooled, but prices remain high, squeezing the consumer. Yet the companies inside STRV are largely insulated from this because they have massive pricing power. Apple stock can raise the price of the iPhone and people still buy it. Tesla stock can adjust prices dynamically to protect margins or seize market share. This pricing power is the primary hedge against inflation that equity investors possess. When you hold STRV, you are holding a basket of the most powerful price setters in the global economy. This is why, despite the doom and gloom headlines, the index continues to grind near all-time highs. The companies essentially pass the inflation on to the consumer, protecting your purchasing power as a shareholder. If you are holding cash in a Fidelity Cash Management account or a Robinhood Cash Management account, you might be earning 4 to 5% yield, but after taxes and real inflation, your purchasing power is barely moving. Equities, specifically high-quality large caps found in STRV, remain the primary vehicle for escaping the gravity of currency debasement. Now I want to challenge you to think about your own portfolio. Most people have a lazy portfolio consisting of a few generic ETFs. There is nothing wrong with that. But have you audited who is managing those ETFs? Comment below how many shares of STRV 500 ETF or any other anti-ESG fund you currently hold, and if the voting record of your fund manager actually matters to you or if you only care about the expense ratio. It's a debate that is tearing through the financial advisor community right now. Many advisors